All right, VC markdowns in 2022. So one of the interesting things that came out, or piece of news in the last week or so, is that Canva, it's a company that they're kind of like a Photoshop, images, image creation, things like that, was valued at $40 billion. And a VC fund called Blackbird wrote down their investment portfolio by 14.4 billion, like a 40% markdown. And they used what they called a strengthened valuation methodology. So let's talk about, Peter, what's happening in the market right now. What is a strengthened valuation methodology? And what are other things that we should see, and maybe even address it from like a regional perspective? You're ready to begin. Go to venturecapital.fm. Also, if you guys want to subscribe to any of other channels besides YouTube, Spotify, Apple, things like that.
Well, I don't know what I didn't read the report, so I don't know what they mean by strengthened valuation. But I think what they're trying to say is, hey, everything is down a lot. We need to go back through our portfolio and we need to evaluate things the way that, what would they have been worth in maybe 2019, right?
Okay.
So yeah, I mean, there's a lot of funds doing that. It's a tricky situation because on the one hand, it really depends on what your valuation methodology is that you've agreed to with your limited partners, your investors, because, in some cases, like you want to take the write-downs now because everybody's expecting you to have write-downs in the portfolio. You want to take those write-downs now.
Unless you're fundraising right now.
Well,
for another fund.
Yeah, but even if you are fundraising right now, you never want to take write-downs, but here's what you don't want to do is you don't want to not take the write-downs, get a bunch of commitments, 6 months later they do a priced round, and then you get hit with the write-down, and there's no question, right, that that it's gotten written down, and now you've got some explaining to do, right?
Okay.
So you kind of want to be able to get in front of it and be like, oh yeah, we've written this down, right? But I think the flip side is some of these valuations, at least in our portfolio, have been set in the last 3 to 4 months. So it's really tricky. Where do you draw that line? We know that the companies probably aren't worth what they were worth, but by how much? I don't know. And I think a lot of VCs are in that same situation. Now, I think in the case of Canva, I haven't seen Canva's numbers, but in my mind, there's no way that they were realistically worth $40 billion, right? Whoever led that round had a very optimistic view of what they could be worth someday, right? And there was so much competition for that deal because it was such a hot deal that people were willing to kind of fight and pay up on valuation and kind of envision this world that I think was pretty unlikely. And I think Blackbird just looked at it and said, hey, yeah, we were all patting ourselves on the back when it hit 14 billion or 40 billion, but everybody knew that was kind of a crazy valuation. Let's bring it down to something more realistic. Let's be honest though, is $25 billion for an app that basically makes it easy to put together Instagram posts that look nice, worth 25 billion? I don't know. That seems kind of rich to me still.
Looks at the revenue stream.
Yeah, but we don't know I don't know what the revenue stream looks like, right? But you asked about the market. So overall, valuations are down massively. And if I have one takeaway for any entrepreneurs that are listening to this podcast, it is that I've talked to a lot of entrepreneurs at all levels, all from seed all the way up to late stage growth. And I keep hearing the same question, which is hey, when do we get back to those valuations we had last year? Those were great. When does that happen? And I'm I don't know if we ever get back to those valuations, right? Those were this anomaly in time where the Fed was had just printed tons of money, was printing lots of money. Government was spending tons of money. Everybody had tons of money in their bank accounts from stimulus and so forth. And everyone could raise a new $20 billion fund seemingly with zero effort. And so there was an insane amount of money chasing a limited number of valuable companies, right? And that just, of course, raised all boats, pushed all valuations really high. I was looking at the valuation report from PitchBook.
Okay.
And what's crazy is you see these charts, and it's fintech trending around median VC value for fintech was bumping between 10 to 15 million dollars for late stage growth. In 2021, jumped from that to almost 30, right? So you see it's like boom. And it's not just like fintech. You look at enterprise tech, same thing, goes from 10 to 20 million. You look at consumer, went from 10 to 14, so not as big, but I mean, consumer's consumer. But historically, they'd been relatively flat, I mean, with a slight increase. And so, look, I think ultimately what you're seeing in 2020 is like everything's dropping, and frankly, it hasn't even dropped enough. Like enterprise tech has only dropped from 20 to 16. Realistically, it probably needs to drop another $6 million, right, for average deal value. So
you're seeing probably a 30 to 40% drop across the board, right?
Yeah, for sure, at least. And those that aren't taking the hit on valuation, they're doing convertible notes. And they're basically saying, hey, we're going to kick the can down the road on valuation. And hopefully we can grow into it, right?
So what do you do if you're a CEO and you raised at terms last year that are never coming back?
I think smart CEOs are cutting burn. They're laying off a bunch of people. So you've seen a lot of that in the news. They are conserving cash. And if necessary, they are raising inside rounds, typically safes, convertible notes. And in some cases, they're reopening the last round, unless the last round was too high of a valuation, in which case they'll do a convertible note to buy themselves more runway. And a good CEO probably should have somewhere between 24 and 36 months of runway on the balance sheet.
Okay.
Depending on at what valuation they last raised.
But the big takeaway is those numbers are never coming back.
I don't think so.
I mean, for me, it's been kind of interesting because back when I got into venture in 2008, 2010,
yep.
At least, I've got more experience with seed, pre-revenue or little revenue.
Sure.
Valuations were like at $1 million, $2 million.
Yep.
And that seemed rich, at least in the state of Utah. I'm sure outside in San Francisco, you might see 4 or 5, but like, my friend who went through Y Combinator got a 35 million. I'm assuming that's the post-money valuation. Blows my mind.
Yeah.
And how it went from 2 to 3 to 35 million, and they even still had no revenue.
Yeah.
Their only signal was they made it through Y Combinator.
Yeah.
So lucky for that individual.
Maybe, but they got to grow into it now, right? So the downside risk here is, you go out, you raise at this high valuation, you never grow into it. And either you have to take a down round, and VCs don't like they don't want to lead down rounds. Nobody wants to lead a down round, right? Because one, it just doesn't signal well. It's like, why are you investing in a company that had to take a down round? They must not be good managers, right? The employees are all like disgruntled or demoralized because like their stocks are not, they may be underwater, right? On their stock options, depending on when they join the company. Like, it's just all kinds of bad. And as a VC, you're kind of like, do I invest in a company that has to take a down round, or do I just invest in a new company? Right?
But where this is market wide,
yeah, it helps. It helps.
Help.
It helps. No, for sure it helps, but it's still not a great spot to be in.
Mm-hmm.
Right? And that's why I think a lot of entrepreneurs, smart ones, are cutting burn, raising additional capital, trying to extend out that runway so that they can grow into that valuation. But like, I think some companies are really going to struggle. Like, we looked at deals last year where they were trading at over 100x ARR.
Okay.
Like, that's crazy. Over 100x ARR. Like, if you go to long-term averages for enterprise SaaS, like they trade at scale, they trade at like 6 to 10x.
Okay.
Right?
Of ARR.
Of ARR. And so
annual recurring revenue for those of you that don't know.
Yeah. And so you look at that and you're like, it's going to like, it could maybe take them 10 years, right?
Okay.
I don't know. It depends on how fast they're growing, but it could take them a long time to grow into that valuation just to have a flat valuation. We're not even talking like an up round, right? So if you're like, think about it this way. If you're a company, growth stage, you're doing, call it 50 million in ARR. You just got valued at 100x. That means that you're valued at $5 billion. And you're still like a kick A company, growing quickly, like have metrics like up the wazoo that are great. and VCs are like, you're awesome, we're going to give you like a premium relative to your peers, and you get like, I don't know, like a 20x, right? Well, at 20x, you got to be doing what, $250 million in revenue? So you got to 5x your business before your next round just for it to be flat. That's a tall order.
For it to be flat, what are VCs expecting at this moment? Are they expecting it to be flat? Is that the goal? Are they expecting it 10 to 20% down round as acceptable? Or are they just saying, hey, what is your growth regardless of valuation? We're going to invest in growth, recognize that valuations are wonky, and then course correct. And
well, I think most VCs, if they're being honest with themselves, are saying, let's encourage the company to cut burn. Let's give them a little bit more money. Let's make sure that they can like make it another 2 years or whatever with some really strong metrics. And let's cross our fingers that they end up at least coming out flat.
Are you seeing companies come back and proactively changing their historical valuation?
What do you mean by that?
So maybe that means it doesn't happen. Say I raised at a 40 million valuation, and I come back and say, hey, because we need to raise again, we're going to update the docs and say it was a 30 million valuation. You now get more equity. That way it's not a down round, and we can continue.
Yeah, I mean, you can't really do that.
Okay.
I mean, you can take a down round. You can issue more shares to prior investors, but I don't know why you would do that, right? Okay. Unless you're in a tough spot and your investors demand it.
Which would...
Or if you have a ratchet in place, like if your investors negotiated a ratchet. But here's the thing. So many companies did not have any structure on their rounds for the last few years because all the VCs were trying to be super entrepreneur friendly to win deals, that there are very few, ratchets and so forth. I think going like this year and going forward, there, especially at the growth stages, there are a lot more ratchets, a lot more structure. And just so you know, the way a ratchet works, like a full ratchet. So the idea is, let's say I invest in a company at a $10 million valuation, let's say that that I meet with the entrepreneur. I'm like, your company's worth 10. And they're like, no, it's worth 20. And I'm like, okay, fine. I really like this company. I want to back you guys. I'll invest at a $20 million valuation, but I'm going to include a full ratchet in the clause. And what that means is in the future, if you raise at a lower valuation, then you have to issue me enough shares so that it will have been as though I had invested at that lower valuation. So if they go out and they raise at a $10 million valuation, then they basically have to send me another amount of shares equal to what I've already put in, right? Because it's half. So I get to own, if I put in $1 million at a $20 million valuation, I go from earning 5% to earning up to 10%. At that lower $10 million valuation, right? That's the idea of a full ratchet. And that dilution basically comes right out of the common or the other investors, right? Of the deal. So it's very punitive from a dilution perspective. But yeah, I think you're going to see more of those. The other thing you're going to see is VCs that step up to the plate to support their portfolio companies and put in pay-to-play provisions to force the other investors to pony up more money too. So we're starting to see that, right? Like see deals where the insiders are saying, yeah, this company needs another $5 million to get to some sort of milestone to survive, essentially. And we're going to put up 3, and all the insiders need to do their pro rata based on their ownership, or we're going to wipe them out. And the way they wipe them out is they basically say, okay, we're going to take every preferred share, if they don't participate, that they currently own, we're going to convert it into common, and we're going to then reverse stock split it 5-1 or 10-1 or 50-1 or whatever it is. And so you end up owning go from 10% ownership of the company to 2% of common with no downside protection, no voting rights or very few voting rights, et cetera, et cetera.
What does that do to employees and founders? Same thing? Happens to everyone?
No, I mean, they only do it for, it depends on how they structure the deal, but usually it's for the preferred shareholders.
Okay.
Right, because the big investors, they don't want to be, if they're going to put up the money, they're going to take the risk. They want to get rewarded for that, and they don't want to be alone. Everybody's got to pony up and pull together, make it happen. But if you look at the company, you're like, another dollar into this company is a dollar lost because this company's going under, then you shouldn't do it, right? Mm-hmm. But for the most part, investors put into pay-to-play positions will pony up the money because it's usually a relatively small amount to the rest of their investment.
Okay. Well, it's good to know.
Yeah, it's probably more than you wanted, but
everyone's just hosed if you raised in the last 12 months then.
Well, if you raised at a really high valuation, yeah, you're in a tough spot, especially if you've been burning a ton.
All right.
And your only saving grace is that, to your earlier point, everybody did that, right? So
still makes it tricky.
But I mean, hey, if you have a business that has a really good, strong business model that can get to cash flow break even, ultimately it might kind of suck from a valuation perspective, but if you can get to break even, you can kind of control your own destiny, ride this out, and then raise money and try to push for growth again, right?
Okay.
But punchline is, if you're holding out for that like 100x, right, multiple on your ARR, it's not coming back. Like, you can't wait like 12 months and it's going to magically come back. Like, if you look at all of the charts over the long run, they're pretty flat. And this was a definite like one-time spike, in my opinion. So I guess the other thing that I would say is I've met with a lot of entrepreneurs that are waiting for it to come back. And they're like, oh, well, I've got enough money in the bank to last another 6 to 12 months. I'm going to wait until things come back to those higher valuations, and then I'll raise. And I think those entrepreneurs are playing a super risky game that I don't think is going to play out to their favor. I think those are the people that are going to end up in pay-to-play situations, down rounds, and businesses that go under, right? Because they'll ride it to the very end of their cash, and then they'll like hope that somebody will back them, and nobody, like, they'll be in an incredibly tough situation because like VCs will have all the upper hand, acquirers will have all the upper hand, et cetera, et cetera. They'll be in a tough spot. So like my advice is smart entrepreneurs are realizing like I got an insane valuation last year. If I close money, good for me, right? I need to do everything I can to like raise more money. If that means at a down round, that means at a flat round, that means at a convertible note with a cap that I don't like whatever it takes, get 24 to 36 months of runway.
Okay.
Right.
Easier said than done, but it's the challenge of every VC backed founder.
Yeah. And look, at the end of the day, like, venture isn't easy, right? Startup land isn't easy. The rewards are huge and they're worth it, but it's not easy to get there.
Definitely not.
So,
well, thanks for your wisdom, Peter, on what's happening in the current market and down rounds and things like that. Make sure you go to venturecapital.fm if you want to subscribe, or hit us up in the comments here on YouTube if you have additional questions, and would be glad to follow up with you. And we'll see you guys in our next episode next week.
Thanks, everybody.